want to look at it. Turning to nearer home, the euro, this remains in a terrible mess. The banking system is not properly repaired. The banks are going to need ferocious amounts of additional capital, almost across Europe, to repair their balance sheets to a level that will allow for the effective transmission of money to businesses. At the moment, about 80% of the loans in Europe are going to the 20% largest businesses, which in a way don't really need the money, and the SMEs, which are the backbone of most developed countries, are being starved of capital. And here, later on, you can see some companies that are involved in fintech which are addressing the issue of loans to small businesses. And I thoroughly applaud and recommend that you look at some of those businesses as future disruptors of the way in which loans are allocated out there in the general economy. But the reality is that QE, which is now being implemented in Europe, and the European Central Bank is buying all the bonds of European countries with the exception of Greece for fairly obvious reasons, and Portugal, is probably not going to be very effective. One of the reasons for that is that the stock of bonds is not as big as it is in the United States, and the bond market already suffers from tremendous illiquidity. The second is that by driving interest rates to negative or zero levels, and James Ferguson mentioned that about half of European bonds are either negative, which is just unbelievably crazy, or at zero levels, you are destroying the savings industry of the countries in which you're doing it. You're also forcing the misallocation of capital, which is one of the reasons why across the developed world, and indeed now in emerging markets, we have zero productivity growth. In this country, as an example, productivity is 8% below the level it was in 2008. And even in Germany, which is held up as a sort of paragon of industrial virtue, productivity is 6% lower than it was in 2008. The capital stock, that's the machinery in factories as an example, is very old across the developed world. And one of the key reasons is that capital is being misallocated into asset bubbles around the world by central bank manipulation. And those asset bubbles take the form of bonds, they take the form of shares, they take the form of artistic twaddle. I recently went to a Berlin art exhibition, and basically putting a couple of lamps together or gluing stuff together will get you 150,000 euros if you're lucky. So I'm thinking about taking up a job as an in-resident Berlin artist, but I don't think I'd be very good at it. But the artistic twaddle is one of the areas in which all this money is flooding, looking for yield. But it's not going into productive investment. It's going into financial engineering and asset bubbles, which are very dangerous and are leading to zero productivity growth and very low structural growth compared to what we have been used to in the developed world and indeed in the emerging world in the past. And that gets back to the point I'm making that overall world growth is very anemic. Now, you may ask the question, is Greece going to leave the euro? And I think the answer is, well, they'll cobble together some sort of deal until at least June, but ultimately it is definitely going to leave the euro. It's going to leave the euro because the Germans will not tolerate all those slackers lying on their sun loungers and being paid for from German taxpayers for very much longer. And if you read Bild Zeitung, the popular sort of Sun equivalent in Germany, every day it's, feckless Greeks, Trojan horses. I mean, every analogy that you can use to make the Greeks out to be lazy, parasitical, and highly indebted on a permanent basis. The last bit is true. I'm not going to make any comment on the first bit. But anyway, the Germans won't allow them to stay in. And I think it will be a tactical error for the Europeans not to actually swallow their pride and pay off or extend and pretend with Greek debt, because it will have an impact on the euro. Now, this time last year, the euro was in the 140s against the dollar, and today it's around 106 or 107. I reversed my position on the euro when it was down at 105. I believe that the euro is now at the appropriate level. I don't think it needs to devalue anymore. Europe's problem is not exports or export competitiveness. Overall, Europe has got a 5% percentage of GDP in current account surpluses, leading again to a glut of savings and a misallocation of capital. So I think the euro is at the appropriate level, and I would be not necessarily long the euro, but I wouldn't take a negative position on the euro. And indeed, the euro might actually go up. It might go up to 110 or 115. But in the short term, if there is an exit by Greece, then the euro is likely to have a fall, and it could go lower than parity. And remember, when the euro started, it went down to 88 cents against the dollar, so it's happened before. But generally, I would take a neutral position on the euro. As far as European growth is concerned, there's a dead cat bounce going on at the moment. You can't have strong growth without strong capital formation, without large-scale lending. And growth in the Eurozone is likely to be between 1 and 1.5% for the next couple of years. Nothing to shout home about, nothing to get too excited about in terms of stock markets, because they've already gone up a lot. I mean, the German DAX is up 24% this year. As far as the UK is concerned, we've got Nigel Farage, one of the party leaders, coming on at 2:30, and he's going to give a UKIP, I guess, view of, as a former investor himself, on how investments are going to be affected by what's going on in the UK. I can tell you it's going to be very volatile.